Hey Bowtie Nation, Joseph Hogue here with an update to our index investing strategy, incorporating some tricks the rich have used for decades, but have only just recently opened up to regular investors. You know I love index investing for that low-stress market returns part of my portfolio. I typically hold anywhere from 40 to 60% of my money in index funds and ETFs spread across the three major asset classes, stocks, bonds, and real estate. Then with the rest of my portfolio, I invest in just a handful of stocks we talk about here on the channel, my very favorite group of stocks with that extra upside. So that's the core satellite strategy we talk about, and it's a great way to get those market returns with the potential for a little more on those individual stocks. But the rich have always had a secret advantage in that simple index fund strategy, a strategy called direct indexing that brings with it three key benefits. I'm going to explain direct indexing, those three benefits over a traditional index investing strategy, and how regular investors can benefit from all of this. Now, direct indexing, a strategy used by the rich for years but just recently opened up to everyone, is an automated investing strategy where a program is used to buy all the stocks in an index. That's different from an index fund, where the fund, like the Vanguard 500 index fund, the VOO, owns the stocks in the index and you own shares in the fund. In direct indexing, you own those stocks directly in your account. But for Main Street investors, owning all those stocks has always been a problem. Just holding the stocks in the S&P 500, those 500 largest companies in the United States, would cost you over $100,000 for just one share of each, including more than $7,000 for a single share of NVR. Then for an index like the Russell 3000, well, you can imagine trying to buy shares of 3,000 stocks. But with innovations like fractional shares and computer-assisted trading, Main Street investors are now able to directly own an index rather than just buying the shares of the fund. And while that might seem like no difference at all, it sets you up for three key benefits over that traditional index fund approach. And the biggest advantage of that direct indexing over traditional index funds is the potential tax savings. Nation, understand, you pay taxes on any investment gains you make each year when you sell a stock. For example, if you bought a stock for $100 and later sell it for $150, that's a $50 capital gain, and the tax rate you pay could be as high as 37% if you held the stock for less than a year. That doesn't even account for state taxes, which could bring your tax bill up to 54%, more than half of your gains lost to taxes. But since the IRS only taxes you on your total profits in a year, the smart thing to do is look for stocks in your portfolio that have fallen in value. If you have another stock you bought for $75, but now it's at $50 each, selling that would recognize a loss of $25 a share. And I know nobody wants to sell a stock at a loss, but hear me out on this because this may be one of the scenarios where you can have your cake and eat it too. Selling that fallen stock with the $25 loss means between the two stocks, you're only at a $25 gain. Now, instead of paying that $18.50 in taxes at a 37% rate, and possibly much more in some states, you're only paying just over $9 because you were able to offset some of that gain. Now, I'm going to show you how to not miss out on any of the upside in that fallen stock in a minute, but in 30 days, you can buy back into those shares of that losing stock to keep your exposure. Now, the problem for index fund investors is you can't do this. You've only got those shares of the Vanguard 500 fund, the VOO. It doesn't matter that some of the stocks within the index have fallen or some have risen. You've only got that whole fund, and you're going to have to pay taxes on the full amount of gains, except with a direct indexing strategy. But in direct indexing, since you own the shares of all those companies in the index, you can harvest some of those stocks that have fallen to lower your taxes. Now, doing all this on your own, tracking all the 500 stocks in the market index, and then deciding when to harvest those losses would be a pain. But with computerized trading and today's sponsor, Frec, it's all done for you. The platform invests in individual stocks within the index, giving you that broad market exposure, but then harvesting the losses on the individual stocks by selling them and swapping them out for other stocks in the index for 30 days. That way, you keep that index level exposure and the returns, but build up those losses to use against other investments and save on taxes. It's that tax benefit with direct indexing, but automated and done for you. Getting started takes just a few minutes, and you can customize your index with the S&P 500, the 64 tech companies in the index, or exclude stocks from the index. You can fund the account from a bank account or an existing brokerage. Frec charges just 0.1% annually. That's half the expense ratio you pay to hold shares of the NASDAQ 100 index, that QQQ ETF. Frec is a member of the SIPC, the securities in your account are protected up to $500,000, and for details on that, you can see SIPC.org. The company is also a registered investment advisor and broker-dealer. That direct indexing and tax loss strategy is entirely automatic. At any time, you can log in to see your returns along with an estimate for how much you've saved in taxes from using the system, as well as the individual stocks in it. Frec is a great way to get your index investing strategy, plus save on taxes. There is a $20,000 minimum deposit, but that will unlock a direct indexing strategy with tax loss savings you won't find anywhere else. I'll leave a link to the platform in the description below. Click through and get a special $250 bonus deposited into your direct index account. Now, most investors only know about the tax savings, but direct investing is also a great tool for diversifying a concentrated portfolio. Okay, diversifying a concentrated portfolio might be confusing. Let's call it, I invested in shares of Meta and now Uncle Sam wants his cut. Let's say you bought 100 shares of Meta at $220 each when we talked about them here on the channel. You'd now be sitting at a 112% return and profits of almost $25,000 and a big stake in your portfolio that might be too much risk. And that could put you in a corner. You don't want that much risk to owning just one stock, tens of thousands of dollars in shares of one company, but selling it to buy other stocks is going to mean a big tax bill. That's where direct indexing can help you diversify away from that concentrated position and at the same time lower your tax bill. The way this would work is that you sell a portion of your shares in that stock to fund a direct indexed portfolio. That automatically is going to spread your risk out among all the stocks in that index, and the strategy starts accumulating those losses in individual stocks to lower your taxes. Then the next year you sell more of that stock, putting that into your direct index portfolio, further diversifying your risk and building more losses to lower your taxes further. You just repeat that process until you've got a totally diversified portfolio and have saved thousands on taxes. This next advantage of direct indexing, I like to call don't tell me what to buy investing. You know I love those index funds for that simple broad market exposure, but when you buy an index ETF, you get whatever is in the index, whether you like it or not. When you buy shares of the SPDR S&P 500 ETF, you're getting all 500 companies in that index. And a lot of times, you might not want that. Don't want to invest in tobacco or oil companies? You'll have to swallow Philip Morris, Altria, and all the major oil drillers like Exxon and Chevron in that index fund. Not sure you want to go down that ESG rabbit hole with Blackstone? You really don't have a choice. And if you don't like where Disney management is taking the company, too bad. The S&P 500 fund holds $2.3 billion in shares of Disney. Instead, with direct indexing, you can construct a portfolio that excludes certain stocks or sectors. In Freak, you can deselect sectors or stocks within a group to fine-tune your portfolio and its exposures. That's something you cannot do with an index fund, customizing your portfolio exactly how you want it. Get index fund-like returns, plus save money on taxes with the Freak platform and the special link below and get $250 for creating a direct indexing account. Or click on the video to the right for my favorite index funds for 2024, the ones I'm buying right now. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.